Stocks sell at silly prices from time to time. It doesn't take a high IQ to figure out that they're cheap, but it does take a temperament that's willing to step up and actually act.
The best investment against inflation is to improve your own earning power. The best passive investment, I think, is a good business.
Warren Buffett, the CEO of Berkshire Hathaway, is widely regarded as the world's most successful stock market investor. With the current stock market experiencing a 20% decrease, high inflation, and rising interest rates, we can refer to his previous interviews for valuable advice to help us maneuver through this difficult time. Buffett's investment strategy is based on value investing, which involves selecting stocks whose market price is lower than their intrinsic or book value. This indicates that the stock is currently undervalued by the market and has the potential for future growth. Warren Buffett cautions against the pitfall of purchasing a stock solely based on the expectation of its price rising. In his view, such an approach is speculative and lacks a solid foundation. Instead, he emphasizes the importance of conducting thorough research and analysis to identify stocks with a solid intrinsic value. But before we get started, make sure you subscribe to our channel and hit the bell icon for future uploads.
Let's talk a little bit about the fact that the market's down almost 800 points this morning.
Yeah.
Concern for you?
Well, no, that's good for us, actually. I mean, we're a net buyer of stocks over time. And just like being a net buyer of food, I expect to buy food the rest of my life, and I hope that food goes down in price tomorrow. When stocks are down, we're going to be buying on balance. And who wouldn't rather buy it, at a lower price than a higher price? People are really strange on that. I mean, because most people, most of your listeners are savers. And that means they'll be net buyers, and they should want the stock market to go down. They should want to buy at a lower price. And they have that feeling that they just feel better when stocks are going up. Some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because your stock goes down, you shouldn't own a stock at all. No, I mean,
what are dumb things? Selling a stock?
Yeah, selling a stock as it goes down. I mean, if you buy your house at $20,000 and somebody comes along next day and says, "I'll pay you 15," you don't sell it because the quote's 15. But some people are not actually emotionally or psychologically fit to own stocks, but I think more of them would be if you get educated on what you're really buying, which is part of a business. If you worry about corrections, you shouldn't own stocks. I mean, if you can't take your stock going down, it's going to go down sometime if you own a stock, so why worry about it? I mean, the point is to buy something that you like at a price you like and then hold it for 20 years. And you should not look at it day to day. If you bought a farm or apartment house, you wouldn't get a quote on it every day or every week or every month. So it's a terrible mistake to think of stocks as something that bob up and down, and that you should pay attention to those bobs up and down.
Warren Buffett is widely acknowledged as a buy and hold investor who adopts a long-term investment strategy and does not aim to sell stocks in the short term to realize capital gains. Instead, he selects stocks based on their potential for long-term growth. This approach sets him apart from other investors who are more focused on short-term market fluctuations. In his stock selection process, Buffett evaluates whether a company has a strong and stable position to generate revenue in the future, rather than solely relying on current stock price trends. Additionally, he considers the stock's price, ensuring it is reasonably priced given the company's current and future prospects.
If I knew what the market was going to do, obviously, but you don't. I don't think anybody knows what the market's going to do. I think you do know whether you're making an intelligent purchase at a given price. Everybody, when they buy a stock, if you're going to buy, say, General Motors that has 1,400,000,000 shares out, you should be able to take a yellow pad like you have there, and on one page say, let's say it's selling for 30. It isn't selling that low, but that'd be 42 billion. You should say, I am buying the General Motors company for $42 billion because, and you should get it on a piece of paper. And then if you want to have a separate piece of paper, it says, I think I know what the stock market's going to do, so I know whether it'll be higher or lower.
According to Warren Buffett, the most effective defense against inflation is to excel in one's field by providing a remarkable product or service that is in high demand, which people are willing to pay for. In his opinion, one's earning power is the best defense against inflation since it cannot be taken away. He suggests that if you offer something of value to society, the value of the US dollar becomes irrelevant. Buffett emphasizes the importance of continuous learning to become a better investor. He also recommends investing in oneself by developing sound financial habits, such as avoiding overspending, credit card debt, and saving money. Moreover, he believes in reinvesting profits to enhance one's financial stability. Take a moment to listen to these two clips.
Keynes said it many years ago that it's an invisible tax that only one man in a million really understands. The best investment against inflation is to improve your own earning power. The best passive investment, I think, is a good business. If you own an interest in a good business, you're very likely to maintain purchasing power no matter what happens to the currency. But it's interesting, in the United States, the value of the dollar since I was born has declined by 94% to 6 cents. But things can work out pretty well even during inflationary times. I mean, if somebody told me when I was born, that the dollar bill is going to go to 6 cents, I might have said, let me go back. I'm not interested in emerging into that kind of a world, but actually it's worked out pretty well, so I have no complaints.
When you go into a drugstore, 7-Eleven or something, and you say, I would like a Snickers bar, and the owner says, oh, I've got something, the Musk bar, at 10 cents off the Snickers bar, you say, give me the Snickers. And if he doesn't give you the Snickers, you go across the street and buy the Snickers. It's probably easier to develop a new car than to compete with Snickers. But some products have terrific moats. Probably Elmer's glue does, WD-40. People that have an iPhone, they want to continue with the product that they've got. They want the new version. It's just easier for them. They've learned how to do everything, and their life's built around it and all of that. And moats are very useful. Costco has a moat in people's mind. I mean, Amazon can raise the price of Prime, 20%, and you can't do that unless you've built something within that image of the Amazon Prime that's based on reality, that you're going to get a lot for your money and you're going to want to use it. And then you can raise prices $20. But if you're selling, some commodity product, you can't do that. You need a moat.
Buffett explained that their investment success stems from making long-term investments in companies that have sustainable and positive economic characteristics. This approach is commonly known as value investing, where the focus is on holding onto stocks with strong fundamentals instead of engaging in frequent trading based on short-term market trends. The goal is to invest in companies that have a sound business model, excellent management, and competitive advantages, and to hold onto these stocks for a long time. Buffett believes that investing in high-performing companies with enduring positive attributes is the key to generating consistent and substantial returns over the long term. To identify promising stocks, Warren Buffett begins by analyzing a company through the lens of his value investing philosophy. His focus is on identifying companies that have a track record of delivering a good return on equity over a prolonged period, especially when compared to their industry peers. This approach allows him to identify businesses that have a sustainable competitive advantage and a strong business model.
The value of American business depends on how much it delivers in cash to its owners over between now and Judgment Day, and I don't think it changes in 10% in a 2-month period if you're looking at it as a business. Now you've got anything can happen in markets. I mean, anything can happen in markets, and that's why they don't ever borrow money against securities. That markets don't have to open tomorrow. I mean, you can have extraordinary events. So I think to some extent you can get some of the instruments that people don't understand very well that have a lot of firepower in them.
Like
and
the volatility index
can
and
trigger.
things that are tied to that.
The idea of people taking a position, and they're gambling, they're not investing. Nobody's investing when they buy some supercharged index on how the VIX does or something like that. They don't need it in their life. It's an unnecessary instrument. Now, they will create instruments that the public will buy, and you can just count on that. Wall Street's been doing that since they met under the Buttonwood tree in 1792 or whatever it was on the exchange. So, but if I'm going to buy a half interest in a McDonald's stand and you're going to run it, or McDonald's franchise, and you're going to run it, I look to the business to determine whether I've made a good investment. And I'm concerned about whether we have new competition, how we do over the years. But it's the business I look at. When you're just looking at the price of something, you're not investing. I mean, if you buy something, Bitcoin, for example, or some cryptocurrency, you're not looking to the asset itself to produce anything. If you buy an apartment house, you're looking at how the apartment house does. If you buy a farm, you're looking at the farm does. If you buy a whole business, you're looking at how the business does. If you buy a part of a business, why shouldn't you look at how the business is going to do? But people get charmed by lots of action and the fact that things are liquid and all of that. And it does have repercussions back into the market when you get something like an ETN arrangement on the supercharged on the VIX. I mean, where you can lose 90% of your money in one day. I mean, that really doesn't belong with the word investment. I mean, it's a gambling form of act.
Buffett's investment strategy emphasizes the importance of having patience, taking a long-term perspective, and buying stocks that are undervalued. What is your opinion on Warren Buffett's investment strategy? Please share your thoughts in the comment section below. If you found this video informative, please give it a thumbs up. Don't forget to subscribe to our channel to stay abreast of the newest videos and news. We'll see you again soon.